Hey everyone, I'm Ed Mehrez. I'm co-founder of Arrow Markets, and
And I'm Jeremy Coup. I'm a quant finance data scientist for Arrow Markets.
so today we'll get right into it. We're going to be giving you an intro to modeling and simulating crypto prices in Python. And this is something that we'd like to also be able to get some feedback and see how you guys think about the actual presentation. So please let us know afterwards, and we'll love that feedback. So how we're going to start, one of the main tools that you see a lot is something called Monte Carlo simulation. And it's great for, it's a general purpose tool, even when you get more complicated models than what we're going to show you. So the first thing that we're going to show you here is how to estimate pi using this method. So first, the first idea is start with a unit square and think about the circle that's inscribed in that unit square. Now, if you compare the ratio of the areas of the circle to the square, you'll get pi over 4. All right? Now, think about randomly dropping pins in that unit square. And we're going to show you a diagram of this as well when we do the simulations. And once you do that, keep track of what's in the circle and what's in the square. Okay? So you can already see that the circle is a subset of the square. And it turns out that you can get, if you look at those numbers, the number that are in the square total divided by the number of the circle, it should be inverted, then what you get is that that's equal to the area of the circle to the square. So there's a little typo, that should be inverted. What you'll get if you just rearrange is that pi is approximately equal to 4 times the number of those dots, number of the pins that are in the square, divided by the number that are in the circle. So here's a diagram where you can see by shading, and all of those points are the points where you're getting those random draws, okay? This is a uniform random draw, okay? And we're going to count all of those that are in the circle compared to in the square. And remember that the square is a superset of the circle. And when you do that, you actually see this pretty cool thing, that as you increase those number of points, the number of samples that you're taking, you get closer and closer to 3.14, right? The approximation of pi. This is the exact number of pi, so we put it there. And as the number of points increase, that gets smaller and smaller, the variance around it. Now, there is still some randomness, right? Because these pins are being dropped randomly. Now, one of the things that Jeremy is going to, I guess, guide us through a bit is what stocks look like. So maybe we can switch off for a second.
Yep, so I can.
Sure.
So, as Ed had mentioned there, we're using these random samples. And it turns out that, just by randomly sampling numbers, you can do a lot of really interesting stuff. He just showed an example where, we took a uniform distribution, which essentially knows nothing. We kind of encoded it into the area of the circle relative to the area of square. We randomly sample these points across it, and all of a sudden we can recover this estimate of pi. And as he showed, as our samples go up, we get closer and closer. So now we want to think about how can we think about these random samples to help us think about, the price of a stock moving into the future. And so here's an example here where this is the price of AVAX from the start of calendar year 2022 to approximately yesterday. And what we're showing here is time steps where we're kind of sampling the price every single hour. So what you see here is just historical data right now. But what we imagine is that this vertical dashed line is the current day, essentially today. And now we want to think about what exactly does the price look like into the future? How can we model that? How can we simulate it? And then how can we start to kind of estimate what the kind of probabilities or the chance of the price reaching different levels will look like. And so we're going to get a little bit into that, but first we wanted to set the stage of what does the problem look like, and now Ed's going to provide a little bit more context behind the math of the kind of model we're going to use. And then one other thing that we wanted to mention is that we have a repo available on GitHub. So everything that you see here today is all available on GitHub. You can clone it and you can run it and you can generate these simulations yourself. And so we really wanted to share this code so that others can kind of see exactly what we're doing. But so to get into some of the models.
Yeah, sure. So one of the things that we see here is the Brownian motion definition. This is going to be kind of the fundamental driver of randomness. And the main idea here is that Brownian motion has these three main properties. The first property is that it starts at 0. That can be normalized to be anywhere, so it doesn't quite matter. The second one is important, though. This random process is continuous. So it never jumps, the process. It's always continuously moving. The third property that's really important is that the increments of this process are normally distributed. So you know the bell curve distribution? This is fundamentally driving this randomness continuously, where it scales with the time step. So that's the difference, the t minus s, you can think about, that's controlling the volatility of the randomness that's driving our procedure. Now, this will be useful. It's just kind of notational convenience to think about those really, really small increments of this process, of this random process that's normally distributed. So there's a few more, I guess So yeah, I mean, getting a little bit more into this, we have the Brownian, you can also embed in this model the randomness in DW. You can scale it by a factor sigma, how much randomness you want in the system. And then also, you can have a drift term. So think about what prices look like. There's often a drift. That drift can change, so these mu and sigmas can change. And along that trend, there's randomness around it, right? So both of those mu and sigma parameters, they control that. They are the things that really control what that looks like. Their drift and volatility. So you might ask, though, with those processes, since they're sampled, the randomness is from a normal distribution, those can go negative. Prices typically don't go negative, right, guys? So one of the things that we have to do is we have to figure out a way to make them positive. So instead of modeling prices directly as a Brownian motion with drift and volatility, with the trend and the randomness around the trend, what we do is we model returns that way. Because remember, returns can be negative. Returns can be very, very large. Returns can follow a normal distribution with this DWT term, and also have the trend term with what returns do over periods of time. Turns out that you get this expression, not going to go too much into it, but this has a solution. And you can express exactly what P is, your price, PT, in terms of the current price, PS, and some of the terms that involve the drift and the volatility of the asset. So this, we're going to kind of push under the rug, but it's in the code. You could look more at it if you want to. But this is an important equation because it gives us a way to simulate. So that's in the next slide. How can you use this? Well, you just take logs, you redistribute over, and then you have this normally distributed term which you can draw from a normal distribution. You have this trend, which you know, and then you have the current price, PS, okay? So then that's how you build things up sequentially. You just keep on going to what the current price is in your simulations, and then you add those random shocks to it, along with the trend term, which is no. So we're going to get into, Jeremy's going to get more into the code of how that's done and what the simulated paths, as you saw, we had the path of the prices, right, and then it stopped at our current time, and we're thinking, well, what can happen in the future? And that's what we're going to show now.
Yep, so I hope you all feel like you're in a math class. It's very kind of dense here, but I promise the next slides are all going to be pictures. And so we're going to translate this into some intuition here. And then also we're going to show a little bit about the code, how we actually do this in practice. And so if there was a lot going on there, I promise we're going to show you something that will start to make sense. So here is just an example of the Python code. Again, this is all available on GitHub. So if you're interested in this, please take it and play around with it. But the main idea here is that this equation on line 87 is effectively like the discrete form of what Ed was just talking about, where we have like this log price in the time step one step into the future is equal to the log price of the current time step plus this kind of drift term that Ed was mentioning, which is kind of how the stock is trending over time. And then here is the kind of the Wiener process or the random component of this part. And you can see here, even though it's a lot of math that is complicated, we're drawing from a normal distribution. And so if you're just kind of taking this well-defined normal distribution, sampling random points from it, and then you're going to see here that from these samples, we can start to get some information about what we think the price will do, given how we think the stock or the AVAX is trending over time and how much volatility we estimate is within the price itself. And so then eventually, and also because it's nice to be able to calculate all these things. For me personally, I like to see them. So we also have the plotting code here where then we go and we plot. And so what does this really mean? Okay, so we talked previously that this vertical dashed line kind of represents current day, like today. Everything to the left of the dashed line is the historical price. And we want to imagine what can the price look like in the future. And so if you go back to the simulation here, we have many time steps that we can simulate just one increment into the future. And we're going to do that for 1,000 increments. And so you can see here that we go from roughly about, time step 1900 to time step 2900. That's 1,000 increments of this. And this would be what we would call one path of the potential future price. And so this is an example of what price can look like. But, it's very easy to look at this and say, well, that's just one example. In reality, there's many different things that this price can do into the future. And so why, what does just this one path mean to me?
Yeah, and I did just want to add, going back to the code really quickly, we can actually change what distribution you're sampling from. Mm-hmm. So that's another thing you can do. If you want fatter tail distributions rather than the normal distribution, you can substitute that out with something like a t-distribution, or even like a Cauchy distribution, something like that.
And that's one thing we'll talk about at the end is if there's any experts in the audience, there's a lot of limitations of what we're showing is a very simple model. And like Ed mentioned there, examples of how this model can be kind of more complicated. There's a lot of examples there. So what we're showing here again is just a single simulation of what price can look like into the future. But if you just have this one path, it's very, very almost zero chance price will really look like this in the future, right? Because price is this random process. So what can we start to think about though? Okay, so instead of simulating one path into the future, again, hard
to see on this.
Yeah, it's hard to see.
You have to believe us. There's many paths here.
Yeah.
There's many paths.
So there's a couple different paths there to the right. And then I think hopefully in some of the future slides, you'll start to see more and more of this.
We can see it well here.
So now what we have is 5 paths. And, you can kind of see here, it's a little bit tough, but there's all this kind of random going up and down, but just 5 different examples of what the price can look like into the future. And that's good. But ultimately, again, 5 examples of what the price can look like into the future is not super informative. What we really want is many different examples of what the price looks like.
You can see it better there.
Right? Yeah. So now we start to get a sense. Each one of these, this is, I forget exactly how many, maybe 500 different examples. And so each one of this kind of cloud of paths is just a single path. But once you start getting many, many, many different paths, you can start to see here that now we have something that looks like a distribution. And the distribution is over all these different paths that could be realized into the future. And so now all of a sudden you can see, we showed one path that just kind of went down like this when we showed one. Now you can start to see kind of the range of outcomes and the range of possibilities of what is possible with this price into the future.
Yeah. And one really cool thing that you guys can try when you're playing around at home with this code is you can plot the 2 sigma bounds which are 2 sigma square root t minus s, basically like the amount of time that you're going. And you'll see that almost all of the paths fall into that. And that's intuitive if you're thinking at every point in time, there's this normal distribution in which you don't go much more than 2 sigma. It's very unlikely to go out on either side from 2 sigma. So it's another cool exercise if you guys want to try it out.
Yep. And so now we're starting to get a sense as to, okay, instead of thinking about the future price as a definitive thing, like AVAX will be at $150 into the future, or as a single path, like, okay, this is the definitive way that AVAX will kind of evolve in time into the future. Now what we're starting to see here is this distribution of possibilities. And as Ed had talked about at the very beginning of this, is that the way that we describe this distribution has 2 key parameters. One is the drift, and one is the volatility term. And so here what we're showing is a simulation where the drift was set to 0. And so that's why kind of the middle of this cloud of potential paths is equal to the starting point of the price. And then, so now what we want to do is we want to start to show, if we play around with these parameters, how does the simulation get impacted by different changes of the parameters? So what we're going to do here now is we're going to go back to the code. And as we said, we have this sigma term. And the sigma term is a parameter that defines the volatility, how much volatility was in the price. So what we're going to do is we're going to take our sigma and we're going to basically divide it by 3. And then what we want to see is how does that impact this cloud of distributions of all the different prices. So just to keep in our mental model the picture, this is what it looked like with the original sigma. Now we're going to divide that sigma by 3 and simulate. And what does it look like? Now all of a sudden the price is much tighter. And so you can see here that that sigma parameter is controlling the spread of how much these price paths will kind of diffuse out into the future.
Yeah, and this really is the main bread and butter type of mathematical model. It even underlies Black-Scholes-Merton and a bunch of other models. And that volatility, what you hear when you're saying, okay, volatility, this is really how to quantitatively characterize it.
Mm-hmm. Yeah, and you can see how important estimating these parameters are, because again, if we go back, this cloud of paths looks much different than this cloud of paths. And now let's say that let's go and do it the other way, where instead of having sigma divided by 3, let's make sigma multiplied by 2. And so now we're making way more volatility. And it's kind of hard to see some of these paths that go all the way up here. You almost maybe have to believe me. But if you look here at the horizontal axis, what you can see is that, I had to scale the graph up to 200, 225, because when I made a sigma that was 2 times as large as the original simulation, all of a sudden we have some potential price paths that, if you're an AVAX holder, would make us all very happy here if AVAX goes to 200. But that, the process can get a lot more volatile with playing around with that parameter. And so it is, as Ed mentioned, a very, very important parameter when you're thinking about what is the potential outcomes of this process. One other parameter, though, that we want to play with is the drift term. And so if we come back here, the drift term is captured in the code in this part here, where basically we originally set mu to 0, but now we're going to set it to a positive value. So if you look up here, this positive mu is now a positive constant. And what we want to see again is, this is going to have the original volatility or sigma that we started with, but now instead of having a mu set to 0, we're going to set the mu to a positive value. And again, we want to see how that impacts the simulated prices. And so now all of a sudden, previously when we saw this cloud of price, it was centered kind of around the starting price, and then it kind of diffused out from there. Now when we have this drift term and we set it to a positive value, you can see that this, the prices are all drifting upwards. And so again, if you want to think about kind of how you're modeling and simulating these prices, this mu or the drift is extremely important. And so now we want to show what does a negative mu look like. So here what we're showing is, again, same volatility as the original simulation, but now just have a negative mu term. And you can see here that, like you'd expect, the prices kind of drift down because that drift term is now negative. So these are the two key parameters. And I think what you've seen here is, if you just close your eyes and pick these parameters out of a hat, you can get many different results. And so how do we actually learn something from the historical data so that our simulated prices actually are meaningful and are based on what has happened in the past? And so that's what we're going to show here. So,
Yeah.
Okay.
There you go. Sorry.
Do you want to?
Yeah, we can talk about that, I guess, after.
Okay, yeah, let's go to this part first. Okay, so what we're going to show here is, so what we've learned so far is that we have this kind of random process. It's defined by these two parameters, the drift and the diffusion. And now what we want to do is we want to learn something from the historical data so that we can fit that mu and the sigma and get some kind of meaningful projection of what the prices can look like in the future. And so we put this here. You don't have to worry too much about it, but this basically is getting some historical data from AVAX and then kind of sampling it at a fixed frequency, which we defined here at 60-minute intervals in the code that's available on GitHub. And then now what we're going to do is we're going to calculate basically every hour, what was the percentage change in the price. And then we're going to calculate the standard deviation and the average of those hourly changes of the price.
Yeah, so that's really important with this nice model, the Brownian model, the one that underlies Black-Scholes, Merton. One of the ways that you can just estimate these parameters is really simple. You just take the observed mean for whatever window of time you're looking at for returns and the observed standard deviation. So that's how you get your mu and the sigma.
Yep. And so do you want to go through this and then we can show the example?
Yep. So now getting back to how we want to estimate probabilities, how does this all tie in to what we spoke about in the beginning with the Monte Carlo simulation and to estimate pi? Well, it took a little while, right? But this is really one of the areas that you really see that power. Once we're simulating all of these paths forward, once we have our estimated mu and sigma from the data, from doing the mean and standard deviation calculations on returns, then we can go back and we can ask questions like, what's the probability at some point in the future, big T, that the price of this asset is above a reference price? Okay, and in option lingo, that might be your strike, right? So you might want to look at what is the probability of this thing being profitable. Or, if you're just looking at the underlier and you want to know how likely it is to go above a certain price, this is the same type of calculation. How do we do it given these simulated paths, though? How do we do it given the fact that we've got all of this nice new machinery to deal with? Well, you just take the number of simulated paths where PT is above that K, and you divide it by the total simulated paths, bam, and you have your probability, okay? So all of that machinery was for this purpose, that we can go back, we can think about Monte Carlo, in that we can think about the number of them, just like a simple probability, how many of these paths go above it versus these. Similarly, if we're thinking we want a range, you want to kind of know what the probabilities are that the price will stay in a certain range, then you can think about it the same way. Just count the number of paths that are within that range divided by the total number of simulated paths at a particular time, big T, okay?
Yep. So now we can show an example of what this actually means in practice. So as Ed had mentioned, we have all these simulated paths. We can pick a number out of a hat. And so here, I think in the code, we chose 150 and maybe like $60. And that's now these horizontal dashed lines. And so now let's say we have 200 or 500 total paths, and we want to say, well, what is the probability that at expiration, or 1,000 hours into the future, what is the probability that AVAX will be above 150? Well, all we do is we go to the terminal kind of time step, and we count how many of these paths are above this horizontal dashed line, and then divide that by the total number of paths, and then that becomes the probability that, you know, the price will be above that at the final time step. Similarly, for the lower price, you would count how many paths are below that horizontal dashed line. Or as Ed mentioned, you could do the inverse of that, where if you have these two dashed lines and you want to say how many, you know, what's the probability that the price stays within this range, you would just count how many paths end within those two horizontal dashed lines divided by the total number of paths. So all of a sudden, we have this very simple, intuitive way to start to estimate probabilities and what is the chance that, you know, price will end at some particular, above some particular price or below some particular price.
Yeah.
And we're about out of time, and we want to have some opportunity for Q&A, but we did just want to mention, because if there are any experts in the audience, you'll probably say like, well, you know, there's a lot of problems with this model, and we totally agree. But some obvious limitations of this model would be that there's no jumps involved. So real price can kind of move and then jump and then move and then jump. It doesn't mean that you can't add jumps into this framework, but that we're just not simulating it in this example that we provided for the workshop. Another really obvious limitation is that we chose a volatility sigma term that is constant during the entire time that we simulated. In reality, the volatility is also a stochastic process. And so there's other more complicated models called like stochastic volatility models, where both the price is a stochastic process, but then also the volatility is a stochastic process, and they're correlated with each other.
Yeah, definitely. So there are different limitations. You know, you guys can look those up on your own. We want to get questions now, so let's go on to that. Oh, it's hard to see that, but please follow us on Twitter with Arrow Markets. Please also, you know, feel free if there are any questions, you can come up. Does anyone have any, maybe? Okay, cool. Yep.
Yeah, hi guys. That was a great talk. I was just wondering, is there anything taken into sample difference in volume rates? Right? Like, so if you're tracking volume like degradation over time, does that change your outlook model? Yeah,
so in this very simple model, it does not. And this is something that's really problematic with Black-Scholes in general, is it's not demand sensitive. It's like it doesn't take those state variables into account. But in this framework, going back to that mu and sigma, you can start to embed them in there and start to think, well, how does that change the volatility? When I see in the past, you can even do models that like do a regression on them. How has volatility changed in the past when there have been increases in volume or decreases in volume? Or how has the trends changed over time? That would be one way you could start to bake it in to this formulation.
Mm-hmm. Other questions?
Yes. Is there a way to differentiate between bull and bear markets using this model?
Yeah, so when you look at the historical price and you start to estimate the mu and the sigma, if it's a bear market, your mu's will start to be negative because the price will be drifting downwards over time. And in bull markets, the opposite would be true, which is your estimated drift term will start to be positive. And so that's actually one way that you can just, you know, objectively from the data, try to determine yourself, is this a bull or a bear market? Because if you start to estimate the mu and it's positive, but you're convinced you're in a bear market, well, maybe the data is trying to tell you something else.
Hey guys, just really quickly wanted to say, please feel free to pick up croissants and some swag. We didn't have enough time to get brownies, but we have croissants, chocolate croissants instead.
Yeah, we wanted to bring brownies for the Brownian Motion, you know,
Yeah.
that was the whole idea.
Didn't quite work out. Our oven didn't really work at the Airbnb.
Thank you very much for your nice speech. I was just having this quick question. In your repo, is this unlimited for AVAX, or is it also open for any other?
Yeah, so actually to get the historical price, I'm calling a Coinbase Pro API where you can put in any ticker.
Okay.
And so Actually, can
just
you
with the ticker.
pull up the repo on your, do you have Wi-Fi or no?
Yes, I
Do
do.
you want to try to pull that up?
Sure.
So we can share? Yeah, because we wanted to share the repo with everybody, so we're going to try to, pull it up so that others are able to see so here is the repo. So it's github.com/arrow-dfms/Brownian Motion. And so the two so we built this in a Jupyter notebook, so it's kind of easy, intuitive, and the graphs are all there in place. So we have two Jupyter notebooks. One is for the estimate of pi that we showed at the very beginning, and then the final one, sampled price path, is going to give you all the code to sample all the different price paths into the future. Any other questions? Yep.
Thank you very much for the good talk. It's Sevan from Avengers. I want to ask a question about if you try to prove that your algorithm works in a retrospective way. For example, you can already simulate for January 2022 based on the previous data, and then did you do anything like that to validate your?
Yeah. So the model is very general. I think the real thing that you're trying to figure out is how valid are my estimates of the mu and the sigma. And so, but the challenge though is that, your simulations are going to be like many different outcomes. And then now reality is just going to be one. And as long as it's within the bounds of your like probabilities, then it's very difficult to like assess if your model was right or not, because, you're just providing, ranges of outcomes and then probabilities. But yes, more generally speaking, you can assess effectively like a probabilistic forecast against a single realization, and you can start to get a feeling as to how good your models were.
Now, I would be remiss if we did not chill a bit, of course. Please come and join our trading competition. We're going to be having it on testnet in April. So just be on the lookout at Arrow Markets, arrow.markets. And if you sign up now, you can actually pre-register to get a special boost. And we should have cards and stuff in the back for you guys to get.
Yep.
Hi guys, thank you for the great lecture. It was great to have a good lecture in a room after all the crappy online Zoom class we had. So in the pin analogy, the pins I think add equally to the probability, but counting the numbers for the lines that go behind this range, would it matter if the line reaches that above range closer or later in time?
Not for the probability, but
You do have to cut it off, though. So if you really want to know at a particular time, you have to count how at that time, if it's above or below.
yeah.
So it's really important to get that right.
Yeah, but like
in the counting.
if a path goes like $100 above your like threshold value, it just counts equally like 1 out of 1,000 for the probability. Where it matters more though is, we didn't have time to get into this, is that ultimately this is a framework that you can think about options and option prices. And now those paths that go well above start to give you a lot more exposure with that option. And so, for example, if your threshold value is, say, $100, and you want to buy a $100 call option, the further it goes above, then you're going to have a lot more exposure than if you just barely go above. And so there are use cases where you want to know how much it goes above, but in terms of just the probability, each path is kind of equivalent to any other path, and all you're looking at is kind of if it's above or below the threshold value.
Cool.
Just curious to hear what's your experience like been with working with like ML or AI techniques versus more traditional like statistical techniques in estimating future prices?
Good question.
Yeah. I have an extensive background in ML. I think Ed does as well. For estimating future prices, I think I don't play around with that. I play around with these like stochastic volatility models and stochastic processes. And so, yeah, there are ways to, massage this into a machine learning framework. I would say that my thought is, in general, that machine learning is challenging when you have non-stationary process. Like if you have something that's kind of changing in time, and not just like the price changing in time, but like the overall kind of statistical summary of like everything is kind of not very like valid or stationary, then you have challenges. But I don't know what your thoughts
No,
are.
we actually have a bit of a disagreement about this. So our tech lead, Preston, and I, we do research in reinforcement learning as well. And it's true, Jeremy has valid criticisms on this, but it can be very powerful in terms of, especially some of the tools in deep reinforcement learning and deep neural nets, to really fit prices, to understand volatility. But it's also dangerous. You could think you have a very good model and then be fooled, oftentimes from overfitting. So it's really a bit of a balance there. But there's a ton of great work. One of the things we have in the pipeline is a deep hedging framework. That's more about the optimization. How do you pick up how to hedge options the best way? Because one of the things that Arrow Markets does tries to emulate what an options market maker does. And something like deep hedging is already actually being used at some of the big firms out there today. So definitely a lot of exciting stuff there and a lot of things to be explored on the how to get involved in machine learning and pushing that on. But time series is very difficult. What Jeremy's saying, time series has not quite been cracked. I think we have to go, but we can talk offline. All right? Yeah, cool. All right, yeah, and if anyone else has questions, thank you so much for coming.
Yep.
And we really enjoyed giving this presentation. Please give us some feedback, and thanks again.
Thank you.